And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Inflation-fighting ETFs are all the rage, but there is a bewildering variety to choose from. Let's talk about those choices with Kevin O'Leary, Chairman, O-Shares, and Scott Ladner, CIO of Horizon Investments, which has $8 billion in assets under management. That's a little over half of which are invested in ETFs. Kevin, good to see you again. With inflation such a big issue, tell us how you're positioned and what should investors be considering to address inflation?
Well, people don't remember inflation, but where you want to be in equities, particularly when rates start ticking up, is in companies that have pricing power. In other words, their goods and services are necessities for people, so they're willing to take a small increase in price, sometimes a larger one, as rates go up. And so companies that don't have pricing power end up getting their margins squeezed. So right now, healthcare looks really good. And also consumer cyclicals look very good. Things that people need in times of inflation, what they eat, what they drive. And so that's why you're seeing energy prices going up. At the same time, energy stocks going up because people have to buy energy to move around. What gets hurt are things like high PE speculative stocks and some technologies where all of a sudden you don't have such an accommodative environment where the Fed is being very easy on everybody. And as interest rates go up, PEs go down, prices correct on equities. But even as rates go up, equities are the place to be because fixed income gets hurt a lot more.
Yeah, you know, I see your O-Shares Quality Dividend ETF is trading about in line with the markets. You know, you've got Procter & Gamble in here, Johnson & Johnson, you've got Microsoft, you've got Home Depot, Verizon among your biggest holdings. These are all high quality, high dividend yield. But is that a good inflation fighting strategy for right now?
Yes, because most of them have products and services that people need. That's OUSA. It's basically a subset of the S&P 500. It looks for the highest quality balance sheets, companies that are generating cash, companies that have high return on assets that do distribution. So if you start thinking about what you want to own for the rest of this year, you want a subset of the S&P 500. Just owning the index could be very risky because lower quality balance sheets like the airlines right now may not perform as well as rates go up, because that means their debt servicing goes up as well. You think United Airlines started with $7 billion pre-pandemic. It's over $20 billion in debt now. Not a name I want to own coming out of this. I'd rather own the higher quality names. And the whole idea of OUSA is to temper volatility, looking for names that do better in drawdowns. And we're having volatility now all of a sudden because people are trying to guess how many hikes there's going to be by the Fed. Is it 2? Is it 3? Is it 4? Is it more? Nobody knows. And as a result, you're starting to see vol. And in names like OUSA, those big, large cap, high quality cash distribution names, as I like to say, cash flow, that's where you want to go, where there's the cash flow. And that's what OUSA has.
You know, by the way, Kevin, love the backdrop. Wish I was there wherever you are. Scott, you use ETFs extensively in your portfolios. With bond prices dropping, you've been talking about alternatives like senior bank loans, for example, convertibles, preferreds, even potentially high yield. These are bond-like instruments. So what are the advantages of these particular instruments right now over just, say, owning bonds or a bond fund?
Well, look, I mean, investment-grade bonds right now, I think Kevin would probably agree with me, it's dead money. And so to the extent that you can get out of that, any way you can get out of that is probably a pretty good idea. And we generally agree with Kevin. I think equities is the place to be. However, if we are stuck, like if we do need to get some sort of bond allocation into a model because there's constraints or there's security selection types of things we have to take care of, then the things you were mentioning work pretty well. Preferreds, converts, bank loans, high yield, all of these types of securities can help at least give you a chance. The catch, though, is you've got to risk manage it in somehow. Because all of those securities were down, all of those asset classes were down 20 to 30% in March of 2020. So not exactly the kind of return profile that you'd want out of a bond portfolio, but at least they give you a chance if you're stuck having to do something inside of bonds. We do agree equities is probably the better place to be.
Yeah, but they turned around fairly quickly. And Kevin, I wonder what you're thinking about these alternative instruments. We always bring out senior bank loan ETFs, for example, short term. The rates rise fairly quickly because they're fairly short term instruments. Is that an alternative here to simply owning a bond portfolio?
It is an alternative if you're forced into fixed income. I mean, I'm in a mandate where I have to have a minimum of 30% fixed income, and that's what I've done. I've taken it down to 30%, 70% equities. But I'm looking for shorter duration, triple B and above, in my case, it's pretty miserable returns. However, it is risk management. It's sort of how long and at what quality. And there's a lot of volatility now in fixed income. We just haven't had a market like this in a long, long time. My guess is that that portfolio will probably underperform equities. I'm looking for 8%, earnings growth in 2022, plus 1% dividend yield for a 9% total return on my equities, even in times when the Fed is raising rates, because most of the companies I own in OUSA have pricing power. I do not think I will make 9% in my fixed income portfolio. I'll be happy to make 3.5%. I'd be happy not to lose money. This is an extraordinary time. Fixed income, which worked for 32 years, is not working anymore.
That's a very good point that Kevin's brought up, Scott. You've also said, I've heard you say this, that 80-20 stocks to bond portfolio is now the new 60-40, that nobody should be doing 60-40 stocks to bonds, 80-20, and you can hedge protection. And can you explain why 80-20 is the new 60-40? I know you've also been talking about other kinds of things, hedged equity instead of bonds for diversification, like low volatility ETFs or covered calls or collared strategies. What might they be able to offer as well? But just explain why 80-20 is the new 60-40. It seems you agree with Kevin here.
Yeah, I mean, absolutely. I mean, look, we generally think Kevin's got it right. I mean, you want to be in equities as much as you can, but there are going to be constraints sometimes on how much equity you can put into a portfolio. So if you are under some of those constraints, one thing you can do is you can say, listen, if 60-40 is sort of the standard portfolio, and I just know going in that 40% of my money is dead. Like it's going to get, like Kevin said, you're talking about if you're lucky to get 3% return, probably lucky to break even this year over the next couple of years, lucky to break even. And so I just want to minimize my allocation to that dead money. But I need to get the same kind of recurrent return profile, the same kind of risk characteristics as a traditional 60-40. One way to do that is to say, listen, we're going to cut our passive fixed income allocation in half, and we're going to replace the equity allocation with some hedged equity types of securities. So, Kevin mentioned the OUSA. Those are lower volatility types of securities. There are other explicit sort of low vol types of ETFs like HUSV or USMV. These are explicitly low vol ETFs. There's other ways you can use derivatives inside of some of these ETFs to get some of these return profiles that are a little more consistent with a balanced portfolio. So something like XYLD, which is a covered call ETF, or HEQT, which utilizes collars. These are different ways to skin this risk management cat and just get us out of this box of having to invest 40% of our money in something which we know is probably not going to do very well for us and for our clients for the next 3 to 5 years.
Yeah, low volatility is an interesting strategy. I mean, to me, it says things like consumer staples. It says Procter & Gamble. It says utilities, for example. Is there any, if Kevin is right, then we're in for a higher volatility environment. Lower volatility might make sense as a balance, Kevin, at all. Does low vol make any sense, what he's talking about?
Yeah, it does, because remember, a lot of mandates where specialized ETFs like we're talking about are being used are in trust mandates or pension mandates or sovereign mandates where they mark to market every day the AUM, the assets under management. And so volatility is not their friend. They don't want huge swings in portfolios like that when an endowment fund is trying to distribute 6% a year. And so for the period in the last 3 years, last 36 months, volatility was extremely low and more risk assets were put on even to the most conservative mandates within sovereign or pension. Today, I think we're going to see a switch back to lower vol. I think it'll become very favorable to be in higher quality names. So as you interpret lower vol, the reason, a Procter & Gamble doesn't have a 10% swing in its price in a day is it's been a steady eddy for 40 years. And so people buy their stuff and use it to live. And they, just recently talked about how they've had pricing power in the first inkling of inflation here. And those are the kind of names where you can hide in the weeds. For me, the low vol mandate has moved up to 40% of the holdings in our operating company. And I feel very safe being there. We've trimmed a little bit in where there's a lot of risk and volatility, because at the end of the day, when you're mark to marking in a pension or an institutional fund, it's what it's worth at 4:01 in the afternoon. And so you're going to see managers move towards these strategies of preservation of capital for the back end of this year. And getting 23% out of the S&P this year, I think, is impossible. Be happy with 8 or 9.
Yeah, it's that's very interesting. You mentioned 8% earnings growth, 1%. That's close to the historic norm. With the dividend, the S&P has historically yielded 8 to 10% a year, and yet, guys, we haven't had that recently. The S&P has averaged 15% return a year since 2009. That's rather remarkable. If you figure 10% is the norm. If you believe in mean reversion, it would certainly argue for what Kevin is saying there, Scott. Are we entering a period of maybe not negative returns, but at least subpar returns to sort of get back to that mean reversion? 8 or 9% return would certainly make a lot of sense after 15% average in the last 12 or 13 years.
It's certainly, Bob. I mean, look, we could get that, but averages can be pretty misleading. The period over which we're averaging is going to tell us a lot about kind of the study that we're going to go under. But really, like at the end of the day, gains are a great risk management tool. So if we can get exposure to gains, if we can get gains in our portfolios when they're able to be gotten, that ends up being a pretty good risk management tool and a pretty good wealth building tool. And then when we need to play defense, let's play some defense. Like Kevin said, and like we're all thinking, look, the Fed's embarking on a tightening cycle. It's probably not going to be a 23% type of return year. Like we agree with that. But if we can get 7, 8, 9% out of a hedged equity portfolio, that's going to be pretty good and a heck of a lot better than we can do with bonds.
Yeah, Kevin, any thoughts on allocation in terms of size, large cap, small cap, mid cap? Everyone was piling into small cap value at the end of the year last year, and it seems to have outperformed everything else. But and it did all right last year, small cap value. But it's been a long time since that was a market leader here. Any thoughts on size investing?
Yeah, if you're going to a theme now of capital preservation, protecting AUM, the Russell 2000, the raw Russell 2000, which about 2/3 of the names in there have no return on assets or virtually nothing, and a lot of them aren't profitable or provide distributions in the form of dividends. But there is a way to mine the Russell 2000. There's about 1/3 of the names that do actually, they're more larger cap, they're more in the $4 to $5 billion cap. You're going to find them in an index like OUSM, which mines for yield distributions and that little extra growth you're going to get in a small cap name, but avoids companies that are unprofitable or have no return on assets. So it's a more conservative, lower vol version of the S&P, or at least the Russell 2000. And the other zip code that most people have avoided of late, but shouldn't because it's starting to outperform and it's at lower PE ratios, is Europe. Europe has 50 names. You'll find them in Switzerland, in the Eurozone, and in England that are household names in America, Roche and Nestle, names like that. They're in the 50, and you'll find that index in OEUR. And at the same time, why not own those names at a slightly lower PE in most cases than their counterparts here? And there's a lot of recovery stimulus still going on in Europe. So I'm anticipating it might do as well or better than its counterparts in the U.S. this year. Yeah. So I do 40% in something like OUSA, and 30% in Europe, and the rest in small cap. And I think that might do very, very well in OUSM. It's boring, but these days I like boring.
Boring is good. You're right. Well, there's a mean reversion trade. Europe, Scott, Europe has underperformed the United States for years now. Small cap has underperformed big cap. Kevin seems to be talking about a mean reversion trade.
Look, we like mean reversions trade in general. This one might be a little bit more challenging for us, though. Quite simply, Europe and small caps are geared towards expanding economies. When the economy is expanding, when it's growing, and when that rate of change is growing, those types of securities tend to do fairly well, especially Europe. Right now, we think we're probably entering a phase where growth is going to be slowing globally. Not only do we have an EM tightening cycle that's already a year old, we have China not really stepping on the gas in terms of policy. We've got the Fed and other developed markets starting to tighten policy. So overall, we think it's going to be an okay year. I mean, look, consumers and the corporations are flush, so they're pretty good. We're not worried about a recession in the United States by any stretch of the imagination. But we think it's probably going to be a slower growth year, and slower growth years tend to be a little bit more challenging for things like Europe and small caps.
Yeah. I want to get another perspective, so let's get one on inflation and ETFs. Joining us now is Alexi Panagiotakopoulos. He's a partner and chief investment officer in Fundamental Income. He runs the Net Lease Corporate Real Estate ETF. This is a real estate investment vehicle that throws off a 4% yield. Now, Alexi, explain to us how this ETF works and why a triple net lease, first of all, what a triple net lease is and why that's an advantage in an inflationary environment.
Well, look, I mean, frankly, we started this ETF because everything that Bob, Kevin, and Scott are mentioning. This is a boring vanilla strategy that has performed for many years. You look at some of our top holdings like Realty Income and WP Carey, which have been around since the 90s and have averaged 12 to 15% annualized returns and dividend growth of 4 to 5%. In a market that's sideways with interest rates sub 2% and not many places to hide, preferreds yielding, mid fours, high yield debt yielding mid threes. We wanted to create an index that was total return focused and frankly, something that most people own in their portfolio already. All 25 of these names in the index that we've created with NASDAQ exist in the VNQ. However, we've highlighted 25 names that all do the same thing. All these companies own single tenant freestanding real estate. And it's really the real estate of America. It's all around us. It's the gyms that we go to, the convenience stores, the pharmacies, the grocery stores, it's things people need. But we call this the gold rush theory. In the old days, everyone rushed to pick gold. But the people that are still standing today are the John Deeres, the people providing the equipment to generate revenue and EBITDA. And so all 25 of these companies focus on triple net leases where the tenant actually pays property taxes, property insurance, and property maintenance. And so going into the investment, the underlying REIT already knows what their return is going to be, and they're not subject to inflationary pressure like rising labor costs. We don't look at corporate profits because, frankly, rent is senior to an EBITDA calculation.
So I think to explain this simply, just somewhat what you said, the fact that the tenant pays taxes, fees, and maintenance costs sort of insulates you from inflation here, because if there's an inflation here in certain things, the tenant's going to essentially pay that. So you get a sort of bond-like income with an equity upside, right?
That's right. I mean, at the end of the day, these are 25 equity companies. They're all NYSE and NASDAQ traded. And, when you think about a triple net lease, they're not only long-term leases with an average of 12 years, but they also have built-in rent escalators of roughly 2%. Kevin mentioned earlier trying to target fundamental investments that have 8 to 9% returns. And frankly, if you look at underlying holdings of these 25 companies, these REITs are able to buy household names like Home Depot properties and Amazon properties and 7-Eleven for cap rates somewhere between 4 and 7%, with somewhere between 1 and 2% of annualized growth, which compounds over time. And so, frankly, these REITs are benefiting from lower interest rates because you're not really investing in a $10 billion portfolio today. It's almost like a laddered corporate bond portfolio where you've been buying into this over time with various interest rate environments, and they're going to rise when inflation rises.
Yeah. Now, I'm looking at your largest holdings here, National Retail Properties, WP Carey, Realty Income, Stag Industrial, Store Capital. These are all, you characterize them as mission-critical assets, essentially. They own industrial spaces, they own warehouses, they own distribution centers, freestanding real estate, essentially, that's very important to the operations of these various companies, right?
That's right. And really, that's what you're investing in. This is akin to corporate credit and more detailed and nuanced. It's contract risk. What is most important to an underlying company as dividends dwindle? And that is their real estate, because we focus on, and these REITs focus on real estate that is imperative to a company's ability to generate revenue and EBITDA. I mean, Amazon can't generate revenue without a distribution center. Starbucks can't sell a cup of coffee without a drive-through. And you go through, a lot of these are insulated from e-commerce. And frankly, e-commerce, lo and behold, actually requires more real estate than a lot of traditional brick and mortar retail.
Yeah, it's a good point here. Kevin, your thoughts on REITs? This sounds like a very interesting idea here. Essentially, you're going to pass on largely pass on any inflation costs to the tenant at this point. 4% yield seems pretty good. Is there something wrong with the picture here, or is there another way to look at this?
No, I think there is a change of use, though. I'll give you an example. In a lot of my private companies where I sell goods and services, Bed Bath & Beyond closed 200 stores. Very desirable locations. We didn't lose any sales because they basically went direct to consumer in those suburbs. But those buildings themselves are going to get converted into climate-controlled pick and pack storage for anybody that wants to deliver within 4 hours to the people in these dense areas in rural areas as well. So what is occurring in that process, and I'm looking at these deals myself, is maybe the cap rate pre the closing of the store was 5.5%, maybe 6%. It might gap up to maybe 6.5%, 7% during the capex required to convert it into a climate-controlled storage pick and pack robotic facility. But it'll go right back down to a 4.5 cap. So there's a little volatility in real estate pricing during this conversion period. Same is going to happen with movie theaters. There's some other use cases that will change. 1,200 square foot strip malls may get some change there. And I'm trying to figure that out because in real estate's always been a big holding for me, around 31% of our operating company's portfolio. But we have definitely trimmed back on office, AAA office even, and have started to be more strategic in where we reinvested. And we're looking cloud kitchens, for example, things like that. So real estate's here forever. I definitely agree with that statement, but it's the way it's being used is changed as a result of consumer purchase behavior changes.
What about that, Alexi? Are there use changes that you're dealing with, or it's the fact that, as you describe them, these are mission critical, sort of insulate them from use changes?
No, Kevin's absolutely right. There's definitely going to be some volatility. If you look at data, public traded real estate has outperformed privately traded real estate probably 15 of 17 years. And the key here is not only do you get the current return, but you also own the asset. So in the event that Bed Bath & Beyond does close stores, like Kevin mentioned, they were repurposed. They were repurposed into longer-term leases with secondary use, unlike corporate credit where, if you own a high-yield bond and Bed Bath & Beyond goes away, your best case is your recovery, which historically has been less than 50% to bondholders. And so in this scenario, your recoveries can push 70, 80%, but your cash flow stream is still consistent. So in a period of volatility where you might see mid-cap value trading with dividends around 1%, 2%, there's going to be volatility in mid-cap value. In our eyes and in our own portfolios, this is a mid-cap value exposure. This is not just traditional real estate. And that's why we launched this with NASDAQ. It's the first and only of its kind, and it shines a spotlight on a new way of investing. The investing in fixed income of old, like Kevin and Scott both have addressed, is gone. But in an 80-20 portfolio, you do need some current income. And in this fact, income and growth can offset your duration. And this is a new way to invest in fixed income.
Scott, is this a reasonable alternative to owning bonds? It seems 4% is pretty good. What attracts me is this mission-critical idea. It doesn't seem like a lot of places are going to close or have a use change that are mission-critical.
Sure. No, it's a very valid use, a very valid capital allocation for people. I would just kind of use the same sort of warning as with things like high yield and converts and preferreds and loans. And, look, this should not be tourist money. Like, these are specialized and niche asset classes, and with a 4% yield, is going to come a similar kind of risk. There is no free kind of lunch out there, and so I would just say, listen, if we're going to be building these portfolios of these kind of higher yielding types of instruments, let's not fool ourselves in thinking that yield is going to be there all the time. It's going to be a completely smooth ride. These things can have very sharp drawdowns, and so they have a very strong use case, but they need to be risk managed. They need to be actively risk managed.
Yeah. And Alexi, just one final point here. REITs were a big market leader last year, one of the big sectors. They're laggard this year. Is there a particular reason for that?
Yeah, I mean, there tends to be, fund flow issues and a reaction to rising interest rates. But again, this is like a laddered corporate bond portfolio. You're not buying, $200 billion of bonds in a low rate environment and then subject to rising rates. At the end of the day, these REITs were built over the last 20 years. And over time, your income factor and your growth are going to push down duration, and you're going to grow out of this because when inflation occurs, cap rates also move, and these companies are also beneficiaries with very fixed cost models. And so as cap rates jump from 5 or 6 back to 7 or 8, where they have been historically, they're going to capture additional yield. And one thing that's really important about these sector-specific REITs is they have dividend payout ratios of about 80%. And so the dividend yield on these is not a yield trap. These are fundamentally built to reinvest cash flows, and by reinvesting, you're growing out of potential credit losses or inflationary pressures of the past. And so that yield is really generational from the reinvestment.
Yeah, that is one of the characteristics of REITs. They do need to pay out a very large percentage of that cash flow. And that does it, folks, for this week's ETF Edge. My thanks to Kevin and to Scott and Alexi. And we've asked Kevin to stick around and give us his broader thoughts on the markets for our ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.